Right, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we're going to be talking about rate cuts. We're going to be talking about rate cuts to try and stimulate the economy. We're going to be talking about the mass layoffs that's happening across many countries and many different companies. And we're also going to be talking about why stimulation is actually false hope and false optimism, and it won't, in fact, actually save the economy nor prevent the impending stock market crash. So guys, what I wanted to do is take you through a little bit more detail in terms of why I believe the economy isn't actually doing that great, and why I agree with Peter that this economic stimulation won't actually save the economy nor prevent a stock market crash, which I believe is imminent. And just a disclosure, guys, I've been long gold since about September last year. Having said this, none of this should be construed as financial advice. Whatever you see on this video or this channel for that matter, and you should always do your own research before buying anything. And guys, if you're enjoying my videos and want to see more investment ideas for building wealth over the long term, or finding out more about undervalued companies that you might not have known about before, remember to hit the like button, subscribe, leave a comment, and share this video. It really helps the channel grow and helps me to make more quality content like this video. And let's start off with Australia. So the Reserve Bank of Australia has recently cut rates to a record low, which has not been seen since the Great Recession. So they've cut rates by about 25 basis points in order to stimulate and propel the economy forward, as business confidence recently has been weaker than anticipated, and so has the economic numbers in Australia. This has obviously propelled a little bit of a resurgence or a rebound in the Australian markets, but I believe that this will be short-lived. The Fed hasn't yet cut rates, but they've strongly inferred or hinted at the possibility of rate cuts to come, and as a result, after Powell's comments, as you guys are aware, the markets have rallied for the last 3, 4, 5 days straight, in the hopes that this will fix the weakening economy and continue to sustain the unsustainable levels of growth and valuation within the US stock markets today. New Zealand has also cut rates to an all-time low of 1.5%, citing weaker than anticipated GDP growth. As you guys can see, GDP growth is about 60 basis points lower than what it was in the March quarter. So you guys might be thinking, okay, so money's still going to be cheap, people are still going to be borrowing, people are still going to be spending, mortgage rates will be going down, I don't see any problems. And that thinking, I believe, is flawed. And the reason why I believe this thinking is flawed is because I'm going to take you through the amount of layoffs. Not just the amount of layoffs that's happening, but the actual amount of people being laid off across multiple industries in multiple countries, and show you why I believe that, even though people might be cutting rates, that doesn't necessarily mean new jobs are being made, and that definitely doesn't necessarily mean that these people who are without a job will be able to find a job, and if they do, whether it might even be at the same income levels, which then reduces their ability to spend and affects the economy as a whole. So guys, before we jump into this, I just wanted to take you guys through a technical investing term called a dead cat bounce. And the saying came from I guess an old belief that if you drop a cat from high enough and it drops fast enough at a fast enough velocity, even if it hits the ground and dies, it'll still bounce because of the sheer velocity and the height that it's fallen. And so if we look at this from an investing sense, this basically says that it's a false rally. So what happens is the stock market crashes to a temporary bottom, rebounds a little bit, only to further crash massively. And so what I think is happening is that this recent rally within the Australian, American, and Kiwi markets is nothing but a dead cat bounce. And what I think would actually happen is that over time, people realize that rate cuts aren't going to work and haven't worked. People are continually getting laid off and are unable to find alternative employment, or if they do find employment, it won't be at the same pay or the same benefits as their previous jobs. As a result, their quality of life and spending ability and consumption ability reduces, which will, I think, land the economy and the stock market into this flattened cat picture over here you see on the bottom right hand corner. So guys, let's talk about the redundancies that's been happening. So Tesla, second round of redundancies, 1,000 more people made redundant. Telstra, and for my non-Australian and Kiwi watchers, probably the largest telco in terms of the Pacific, lays off about 6,000 people. Okay, IRD, the New Zealand version of the IRA or the ATO, probably one of the largest government employers of people in New Zealand, and probably one of the largest employers in the whole country, had a restructuring plan from 2017 through to 2021. And furthermore, they've laid off another 250 people on top of that recently. MGM Resorts, 800 layoffs. Ford, 1,700 in the UK, 7,000 globally. IBM, more than 1,000 employees. Deutsche Bank, merger falling over may see up to 30,000 jobs at risk. Thomson Reuters, 3,200 jobs by 2020. General Motors, 4,000. Commonwealth Bank. And whilst these are rumors, I think that there are some validity to these rumors that we should consider. And so Commonwealth Bank, guys, probably the largest bank in Australia and New Zealand by a massive margin, potentially laying off 10,000 people. Westpac, 900 jobs, again, a very, very large banking institution. Vodafone, hundreds. And guys, it's not only the corporates. Retail is also struggling. And as you can see, it's not just white-collar jobs, but it's all the way from white-collar down to blue-collar, high pay, low pay, and anything in between. And I think that this is really good evidence that the economy as a whole isn't doing that well, and lowering rates won't actually bring these jobs back, right? So retail, 7,000 different store closures across multiple different brands, with a lot of these stores closures not being replaced. And guys, not only are there some worrying indicators in terms of the job front and the layoffs front, but another good indicator is actually property, right? So real estate assets. And when you guys have some time, I would actually encourage you to do a little bit of research in terms of the Australian housing situation, in terms of how much the prices have actually crashed from their all-time highs. You could effectively argue that the Australian housing market is in a bit of a bear market, and there are a lot of owners who have taken on debt or a big mortgage only to resell what they bought at a substantial loss. So hence they're negative equity. And guys, similar to what I mentioned before about how rate cuts won't actually bring back the jobs that were laid off, I think the point below is a really good example just to show you and illustrate what I mean by that. And so guys, at this point you might be thinking, well, hang on a second, I thought the economy is doing okay. I mean, didn't the government just release some figures in terms of low unemployment rates and unemployment rates at their lowest, and actually new jobs being created at a record level? I mean, isn't the US unemployment rate around 3-4%? Australia about the same, and so is New Zealand. And to that, I say, guys, you should spend quite a bit of time researching and digging into the term underemployed or underemployment, and actually have a look at what this means and the implications of that. And you'll be very surprised, probably shocked, I think, to find out what governments actually constitute as being employed under their standards, and how they're actually reporting on these metrics. And the first video under underemployment, especially that, if you guys have a look at that, you'll know exactly why I'm not as optimistic as the market is in terms of economic stimulation. Lowering interest rates will fix all problems. Okay guys, so that brings us to the end of our video. Now, just a few concluding remarks. When will the economy crash? Nobody knows. When will the stock market collapse? Nobody knows. So because of this, it's really important to have an actionable strategy in place so that if and when things do happen, you know exactly what to do rather than be scrambling and panicking at the last minute. Now, just to, again, give you guys a little bit of insight into my strategy, and again, none of this is financial advice, and you should always do your own research before buying anything. At the moment, I have a small exposure in gold, and I will continue to be long gold because I believe that at the rate money is being printed and the economy is going like this, it's very sensible to have a small exposure to gold. Whilst I do have some holdings and investments in some companies that I feel are undervalued, the majority of my portfolio at the moment is sitting in cash. And the reason being is because I always look to somebody like Warren Buffett, who I believe is the best investor by a huge margin out of any investor that ever was. And so he's got about $100 billion sitting in cash at the moment. And when I look at his annual reports or listen to some of the comments that he makes at his annual meetings, the comments are always around the fact that things are just overvalued at the moment. It's really hard to find a good deal at the moment. And so when somebody like that, who's been investing pretty much since the day he was born, is talking and saying these things, then I really listen. Hence why I've got the majority of my portfolio sitting in cash at the moment, just waiting on the sidelines and waiting for, again, like I mentioned earlier in this video, this false hope or false optimism to eventually subside and resulting in a market crash. Now, again, guys, when will that be? I have no idea. If I find really undervalued and interesting companies, then no doubt I will buy. But of course, at the moment, much like Warren Buffett, I'm waiting on the sidelines, waiting for a really good opportunity to find some really good deals. So guys, that concludes the video today. I hope you enjoyed it. Remember to leave a like and subscribe and share the video. It really helps the channel grow. And until next time, happy investing.